Welcome to NGH Today, your home for clear, credible and timely news from Ghana. Over the past 12 months, Ghana's economy has recorded one of its strongest export performances in recent years, driven largely by gold and cocoa. Official figures show total export earnings of about $31.1 billion US dollars. Gold accounted for roughly $20 billion US dollars, firmly cementing its position as Ghana's largest foreign exchange earner. Cocoa followed with about $3.8 billion US dollars, reaffirming its central role in rural livelihoods and national revenue. Other significant exports, including oil, manganese, bauxite, timber and non-traditional goods, contributed an estimated $3 to $4 billion US dollars, supporting diversification even as oil revenues softened. These inflows have helped stabilize the macroeconomy. Strong export receipts improved the trade balance, bolstered foreign reserves, and eased pressure on the cedi. With inflation falling sharply from crisis highs, the Bank of Ghana recently cut the policy interest rate to 15.5%, signaling growing confidence in stability and opening the door to lower borrowing costs over time. For ordinary Ghanaians, the impact is indirect but important. Export strength helps prevent sharp currency depreciation, which would otherwise drive up the prices of imported food, fuel, medicines and transport. A lower policy rate, if transmitted through the banking system, can gradually reduce credit costs for traders, SMEs and households, supporting job creation and incomes. But relief is not automatic. Prices remain high and wages have yet to catch up. The critical question is how Ghana uses these revenues. What Ghana can do with the windfall to build the nation. 1. Ring-fence infrastructure investment. Dedicates a defined share of commodity revenues to roads, rail, ports, and power, especially maintenance. Well-maintained infrastructure lowers business costs, improves market access for farmers, and boosts productivity. 2. Accelerate energy reliability and transition. Invest in grid upgrades, gas infrastructure, and renewables. Reliable power reduces outages for industry and services, attracting investment and supporting jobs. 3. Deepen value addition. Channel funds into processing gold refining, cocoa grinding, agro-processing, and bauxite aluminium linkages. Value addition keeps more income at home and creates skilled employment. 4. Strengthen local finance for SMEs. Capitalize development finance windows and credit guarantees to ensure the interest rate cut reaches productive businesses, not just balance sheets. 5. Invest in people. Scale technical and vocational education, apprenticeships, and health infrastructure, especially in mining and cocoa regions, to convert resource wealth into human capital. 6. Build buffers and transparency. Replenish stabilization and sinking funds to smooth shocks while publishing clear rules for revenue use to build trust and accountability. In short, Ghana's commodity revenues and rate cut signal recovery, but nation building depends on disciplined investment choices. If revenues are channeled into infrastructure, value addition, skills, and transparent buffers, today's export gains can translate into durable growth and shared prosperity. For trusted analysis beyond the headlines, subscribe, like, share, and follow NGH Today. Ghana first. Africa always.